Welcome to the MUFG Global Markets Podcast. I'm John Cook, and today I am joined by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, April 29th, 2025. Welcome to the podcast, George.
Good to be back, John.
Always good to have you. And I think it's been a couple weeks since we did the podcast, but it honestly feels like months, if not years. I mean, April has been an insane month from a news flow perspective, from a price action perspective. Certainly feels like the longest month I've experienced in a while. What about you, George?
Yeah, no, this has truly been a historic month. Probably one of the most historic months in history. And you and I have been doing this for quite some time. I think it's in the top 10. I can go through what they are, but this was definitely epic and an amazing time period.
Yeah, for sure. Felt 2020-ish, felt 2008-ish. It certainly rivals some of those very
August
eventful.
2011, US
Yep.
downgrade. Yeah, like a lot of those one-off top 10.
Totally. Like somebody's vacation got cut short and they had to come back to the office for sure.
Yeah.
Let's hop right into the episode. So George, it's been, epic, if not exhausting, kind of like we were discussing. But as some have mentioned, post Liberation Day, the kickoff of the tariff negotiations in earnest, the only thing that really felt liberated was the value of the markets and not exactly in the right way.
Yeah, no, I mean, and there was really no place to run, no place to hide. It was true for both equities, for rates,
Hmm.
and for the dollar, and it really didn't feel like there was a place to kind of find shelter, and not what people were expecting, especially yeah, given the sort of news that we got.
Yeah, for sure. I think a lot of people came into the year pretty optimistic, and at least the initial sort of announcement and move was kind of anything but. That being said, there has been some stability as of late with the start of negotiations, retracements on how sharp the future tariff regime may end up. Let's quote unquote table tariffs for now, as that will be a topic for the next 3 months, if not longer. Instead of tariffs, why don't we discuss some of the themes that were triggered by this catalyst? Notably really the de-dollarization fears and what that might mean for the US markets going forward, especially over the medium term. I guess I'd be curious kind of like what, the events over the last, let's say month or so, mean for that in the intermediate term and then more long term.
Yeah, I think this brought back to the surface something that's been really, taking place for years. You can almost say this has been happening for the last 20 years, thinking through the idea of de-dollarization or you know our market's just too reliant on the payment rails from the dollar system, and such a huge topic that we can't cover it in a short podcast. But I think at least kind of brought it back to the surface. Again, a lot of investors, both domestically but also internationally, were really bought into the U.S. exceptionalism trade. That along with that, Trump 1.0 was good for the stock market and for overall risk assets. That there was kind of a playbook that people subscribed to and really didn't think about that potentially, the bad news was going to happen first versus the good news. We'll see if there's good news down the road, but and people were really set up for deregulation, for more friendly business environment, and that favored being long U.S. assets. And a lot of these foreign investors, at least from what you can tell from the price action, probably also unhedged. And so for years, it made sense to be long both the underlying securities and assets of the U.S. markets and then not hedge your currency because the dollar was going up. So you're getting the double whammy in the positive direction. This time, it happened in the opposite direction. And I think that is what really probably led to the sort of violent moves that we saw. In the work that we've done in our monthly, which we were going to publish, goes through some of the isolating the pricing behaviors in the early morning sessions versus the afternoon US only trading sessions. And it clearly felt like this is a flow that was coming from overseas. Notably the way that the euro and the dollar was trading, it felt more like a European slash Swiss slash maybe a little bit Japan. We don't know. More so than some sort of like a non-Europe type flow. So I do think this was just investors maybe were a little bit too over their skis long U.S. assets, which again, this tariff news kind of was a crystallized like, hey, maybe we should kind of take down some of our U.S. exposure, more so than a anti-U.S. trade, so to speak. And so I think that was probably the biggest knock on from the tariff. And then, of course, more local to our space is like the big moves in swap spreads and just, what does that signify? Is there, enough balance sheet in the system? Why was it taking place more so in spreads, not so in treasury futures basis? And, people like to point towards leverage in the system, but perhaps it was more the lack of balance sheet and not necessarily too much leverage because you were not seeing the equal type moves in repo or funding markets. And so I think it kind of like reminded us of course, again, like if we started the podcast, this is like in our top 10 of our market experience in our careers. It does say something that the moves we saw were just, again, use the word epic. They were big. I mean, multi-standard deviation moves and spreads should not be happening.
Yeah, for sure. Epic, historic, however you want to put it. And I would argue that that the excitement is perhaps not over. This week, I mean, I guess locally data has kind of like not been as important to, kind of the news flow coming out of the White House. That being said, there has been some downturn in the soft data. I think increasingly we hear from our clients are sort of wondering if and when that translates into a downturn in the hard data. Today, again, this is Tuesday the 29th. We got some, not great looking JOLTS data, some not great looking consumer confidence data. So why don't we switch our gears to what is an extremely eventful week? As a reminder, again, we're recording this podcast on Tuesday. If I'm not mistaken, we have on Wednesday, we have Q1 GDP. We also have the refunding announcement. We have, it's month-end index extension. We get payrolls at the end of the week. I mean, it just seems like there's a ton going on. And so I'm sort of curious, what your expectations are heading into the data, and kind of, take our listeners through that.
Yeah, no, look, the last few weeks has forced us to all to be political experts, tariff experts, global politics, the geopolitical angles, all these things sometimes are forced on us, but it is kind of refreshing to go back to the fundamentals of just kind of focusing on the macro data to try to understand where we are in the cycle. So even though it's actually a super heavy macro week, it's kind of good to at least kind of have the ability to kind of assess what has been the impact on the hard data. And look, the thing that I kind of worried about is that for months, if not years, in the last 2 years, we've had numerous head fakes on these survey datas suggesting that the downturn was around the corner, and then we would have some sort of rebound in activity, either because government spending would go up or the wealth effect kind of created had a lot of pent up demand for services, which then it kind of kept the economy going for the last 2 years. And we had still some savings in the system. I think we're at this interesting crossroads where there was already an underlying weakness prevalent within the economy, something that I've been documenting for months, if not years. And that's kind of coming to a head with this shock that we just went through. And people are getting just almost defensive and paralyzed and not really both transacting or preparing or doing business deals. CapEx plans are down massively. CEO confidence has really come down a lot. Consumer confidence has come down a lot. So like, when does this soft data translate into actually lack of activity? I think we're going to start seeing it now. And this is a super critical week because, as you said, we have GDP coming up. And we've seen wide range of estimates. If you use like a bottoms up approach, like Atlanta Fed GDP does, they're suggesting that it's going to be a negative number. And after the inventories release that we just got this morning, it might be a really negative number. Again, none of us really know because the magnitudes are so massive, and the changes to imports and exports are so big based on potentially front loading or people trying to get some inventories in before the tariffs started. So there's so many wild swings in the underlying trends of the economy that GDP tomorrow could be anything at this point. But it likely is going to be weaker, and it really sets up for a bad Q2 because April is probably that paralyzing month where very little activity was taking place, which we'll see some of that evidence maybe in the NFP numbers that are coming up on Friday. So this is a super critical. Like we're going to get back to the fundamentals, and it's going to be a a rude reminder potentially this week with this sort of data, and it's taking place the week before the Fed during the blackout. And so this really then makes it challenging for the Fed. I mean, I think look, the Fed will change their tune if they have actual evidence. This could be the week that gives them that. And the markets aren't pricing for a cut in May. I think that it would be really hard for them to really swing towards a cut, and that's not our base case either. We've maintained, as our readers and listeners know, we've maintained our June cut since the beginning of the year. We think the Fed should be cutting. To kind of the whole idea of foaming the runway has been our view that they should try to at least transition and buffer some of this volatility and hope the economy can kind of get through it. The bond market, as we know, is pretty smart and has priced in a lot of that. We have the 2 year that's rallied and continues to rally. That's been like the best kind of Sharp ratio. Whenever you have dips in 2 year notes, has been the best way to kind of get long duration. And we'll see. We'll see if like a lot of this negativity is already in the tape and a lot of bad news is out there, and I get it. But it might finally crystallize now that we've been ignoring all these sentiment surveys, but now the rubber hits the road, and we'll get proof in these upcoming data releases.
Yeah, that makes a lot of sense. So, I mean, it sounds like, like you said, you've been maintaining your call for the Fed to cut in June. May is probably too early, even if some of this, we get some, some poor data between now and then. Like being long 2 notes in that scenario. What about risk assets? I mean, how do they take, a downtick in some more harder data series?
Yeah, no, that's a great follow up because for quite some time, so let's just kind of rewind a little bit. The month of April, at the middle of the month, was looking pretty bad, and has rebounded. And so now, investors in risk assets are kind of breathing a sigh of relief that it could have been worse. It could have been, we're approaching month end. It could have been a much worse month, considering how low we got, into correction territories and close to bear markets in some of the indices. And it was, some reprieve and nice to have a bounce back. My concern is like now that sets you up to fall even further if the data does now prove that we're, either in a recession or getting very close to one, that, bad news will be considered bad news for the first time because there's no easy way out of this one where you can't just unwind, you can't unsee the damage has been done with what the tariff shock has created, but it also just amplified the weakness in the economy. So and earnings expectations are going to come down with it. So we might get a bona fide, just kind of like that garden variety recession, which is never a good thing to. No one ever wants it, but and we haven't really experienced one in many years because we've had kind of these like 1,000 year floods and crises like COVID health shock and the financial crisis was a big shock. We might just get like a typical recession, which we haven't had in quite some time. And I think that risk markets will look up and realize, hey, there's no easy way out of this. We're just going to have to kind of get to the trough, and that's probably lower risk assets from here.
Yeah, so it sounds like the maybe the lows in stocks or the wides in risk assets, over the
That's
last
correct.
month are perhaps in insight in that sort of scenario. Is that right,
Yeah,
George?
yeah. I don't think we've seen the wides in credit, and I don't think we've seen the lows in equities yet.
Yeah, makes sense. Um, and I guess what I would say is there's some, this kind of segues into, you're going to be out with the latest macro to markets monthly. I suspect, the same day that this podcast drops. There's a couple of great charts, including kind of your ranges on various asset classes, including risk assets. So I think that's a nice visual to the last point of kind of where we could go from here in that sort of scenario. It's also a nice section on sort of the reallocation out of U.S. assets after, decades of kind of outperformance to kind of your answer to the first question. So a lot of good stuff in there. So I would encourage our listeners to check that out for more information. And again, if you are still not receiving George's strategy reports directly, do check out the MUFG research portal at www.mufgresearch.com. You can find all your favorite MUFG research from George and his colleagues, as well as sign up to have it conveniently delivered directly to your inbox. George, great stuff as always. Thank you.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.